imagine how crowded your calendar and inbox are. So thanks for making the time for this. And now I'll turn it over to you to answer the question that we posed in the title, correction or crash.
Thanks, Prakash. It's so good to be with you. I really want to thank you for the opportunity. And it's my absolute favorite topic, housing and housing finance. It's good to see you. It's good to see Richard. Richard is a good friend, and
hello, Mark,
him as well. And thank you for the 2 hours to speak. That was incredibly kind of you. No, I think I have about, how long do I have, Prakash? About 15 minutes?
Yeah.
15. Okay. Let's fire away then. So bottom line, I do think the U.S. housing market is going to experience a significant correction, but not a crash. And when I say correction, what I mean is kind of what's happening right now. Housing demand is falling. You saw yesterday's existing home sales numbers. We're down to almost 5 million units annualized. We were north of 6 million, closing in on 6.5 million not too long ago, beginning of the year. Home building is starting to weaken. If you listen, so far it's been more modest, but you can see it in the permits and the housing starts data, particularly for the single family part of the market. Multifamily is holding in better for obvious reasons. And house prices, there, I think it's going to take a little bit of time for the weakness to show up, the correction to show up. There was a lot of headlines yesterday around the median price from the realtors going up, but that is, my read on that was it's simply a mix effect. As you know, it's affected by the mix of homes that are transacting, and the high end of the market is holding up better than the low end, and that biased up the measure. If you look at repeats, I'm sure once we see the repeat sales indices, it's going to show some weakness. And I do think the market is going to struggle here for the next year or two as it tries to digest the significant increase in mortgage rates. As you know, the 30-year fixed rate mortgage is doubled basically. You know, if you go back a year ago, we were well south of 3%. Now we're closing in on 6%, depending on the day. So that's a very large change in a very short period of time. And the correction is largely due to the higher rates, and it's exposing some significant imbalances in the housing market. If you turn to the next slide, the first slide in the deck, I think this kind of shows those imbalances very nicely. This is the percent of metropolitan areas across the country, and there are just over 400 MSAs, metropolitan statistical areas across the country, that have house prices based on our repeat sales index, the Moody's Analytics repeat sales index, overvalued by anywhere from 10 to 20%. It's the blue part of the bar, and those that are overvalued by more than 20%. And this is over time, going back to 2000. The last data point is for the first quarter of 2022. And you can see just how extraordinarily widespread across the country the overvaluation is. This is measured by taking the percentage difference between the actual house price in these markets and the estimated fair value price based on a model of house prices that we use for forecasting and scenario analysis. And the model is a error correction model with an equilibrium equation or trend equation, and that's driven by incomes, household incomes, and construction costs. So at the end of the day, a home's value is the sum of the value of the land, which is ultimately tied back to GDP and incomes, and the cost of the structure, which is tied back to construction costs. Now that varies quite a bit across the country. So if you go to San Francisco, for example, the value of that structure, the value of the home is mostly the value of the land. The structure is not really that important. But if you go to a place like, let's say, Pittsburgh, it's the opposite. Construction costs matter a lot more. So we account for that in our modeling, and based on that, we calculate what's shown here. And you can see over 80% of metro areas are meaningfully overvalued by that measure. Very stretched, and so that you can live with that when interest rates are abnormally low, when the Fed's got interest rates at zero and is quantitative easing and buying mortgage securities and getting mortgage rates down. But that doesn't work in a world where interest rates are more normalized and fixed mortgage rates are back to 6%. Just as a quick sidebar, in my view, in the long run, in equilibrium, economy at full employment, inflation at target, growing at potential, the 30-year fixed rate loan should be somewhere between 5.5% or 6%. So that would be like a 4% 10-year yield plus a 150 to 200 basis point spread, and that gets you to 5.5 or 6. So basically, mortgage rates are back to where they need to be in a long run equilibrium sense, and thus close to fair value. Of course, a corollary to all this, and you can go to the next slide, is just more clearly is that affordability is been hammered by the increase in mortgage rates. You mix these now very high house prices with these much higher mortgage rates, and housing is just not affordable. And you get a really clear sense of that here. Just a simple calculation of taking the median price, assuming a 20% down payment, looking at the mortgage rate, calculating the monthly payment, comparing that to the median household income. And the last column shows the mortgage payment as a percent of income. And you can see at the current 5.7% fixed mortgage rate, that I think that's from Freddie Mac most recently, 35% of the median household income is is paying on the mortgage, and that's with the 20% down payment. And you can see how that compares to other points in time historically in today's dollars, and you can see just how high the payment is. So this really strikes home the point that first-time home buyers are locked out. They just simply can't afford to buy, and thus the collapse in sales. And I think trade-up buyers, they're locked in. The average coupon on outstanding mortgage is 3.5% to 4%. And if they sell and buy, they got to get a new mortgage at 6%. The increase in their monthly payment is too much to bear. And so you'll see some trade-up buying, but a lot of it will be curtailed. So home sales have really gotten completely hammered here. Inventories are rising across the country. They're still low by historical standards, but I suspect that's going to change pretty quickly, particularly in the most juice markets. We're seeing really large increases in inventory, and I think that suggests very strongly that we're going to see some correction in price here. The market is going to correct. I don't think it's going to crash for several reasons. First and foremost, you can go to the next slide. The housing market is very tight. The availability of homes for sale and rent is very low by any historical standard, and that's what I'm showing you here. This is the vacancy rate across the stock of homes for sale and rent, and go back to 1965, and you can see how dramatically the vacancy rate has declined, and not quite at record lows, but pretty close, and a very significant kind of picture from the right before the housing crash a little over a decade ago. That was a crash, and that was due to a lot of factors, including a significant oversupply of housing. We just don't have that today, and this undersupply, this shortage of homes, particularly in the affordable part of the market, you can see is only going to get worse in the current environment. By the back of the envelope calculation in the northwest part of the chart, that shows current housing supply. It's running at about 1.7 million homes annualized. You can see the breakdown: 1.1 million single family, multifamily. Multifamily is actually high by historical standards and will continue to rise given the shift over to rental, because first-time buyers are getting locked out of the single-family market. But single-family is obviously very depressed. Manufactured housing won't add up to 1.7 million, but underlying demand, for the moment, 1.8 million units. You can see how I get there: formations, obsolescence, second homes. Although I suspect we're starting to see some demand destruction here. I expect household formation to really start to tail off because people just can't. You're going to see first-time home buyers continue to rent. You're going to see a lot of people just not form households because they can't afford the rent. And we'll see a lot fewer household formations, here in the very near future. But this is a very striking difference between today and the housing crash, which was a crash. Prices were down, depending on the index, 20 to 30% from peak to trough. Peak was 06, 07. The trough was 2011. Very different kind of environment. Second big difference is the underwriting environment. I should disclose that I'm on the board of directors of MGIC, one of the nation's large mortgage insurers, and I'm the head of the risk committee. So I spend a lot of time looking at underwriting conditions, and they're good. I mean, there's been some erosion recently along debt to income ratios, as one could imagine, given affordability. In the grand scheme of things, pretty small, and there's very little so-called risk layering going on. Layering of different credit characteristics, DTI, LTV, credit score. If you go back prior to the financial crisis, the risk layering was very, very significant. It's very minor today. The other thing is, big difference between today and in the financial crisis when we suffered a crash was just the mortgage products. The vast majority of products today are, because of QM rules and changes under regulation, they're 30-year fixed, 15-year fixed. Back before the crash 10 years ago, a little over 10 years ago, you had all kinds of wacko mortgage products, 2-year subprime ARMs, neg am loans, all kinds of things going on. So very, very different kind of credit environment. And then third, and you can go to the next slide, is you just don't see the kind of speculation in the market that you did back prior to the financial crisis and the crash. That's shown here. The green bar left-hand scale is the number of estimated flips based on transactions. We look at when a home is purchased and then when it's sold. And if it's purchased and sold within 1 year, we define that as a flip. These are speculators, people looking for a quick buck. And you can see that the levels have started to push up here. No surprise, given particularly in the juice markets in the South and the West. But on a percentage basis, they're still quite low, and much lower than they were prior to the financial crisis and that crash. There are some markets where flipping is more elevated, and we need to watch that. Particularly in the Southeast and in the West. So poster child would be Charlotte, North Carolina, maybe a Tampa, Florida, Phoenix, Arizona, Vegas. But there's a handful of them where I think this is a real threat. The other thing I'd point out is you've also seen a very significant increase in demand from low levels, but still an increase in demand from more institutional investors that are buy to rent. And while I think they've gone to the sidelines here to see if prices don't come down, they're not sellers. This is a long-term business model, and I think that puts a proverbial floor under price and makes it much less likely to experience a crash. So you sum it all up, and you go to my last slide, which is kind of the bottom line in terms of forecast. And you can see on the left-hand side, that's the outlook for house price growth. You can see history and the forecast under different. Here in the baseline is the blue line. Basically, I'm expecting national house prices to flatline here over the next few years, maybe a small decline by this time next year. But you can see that is the baseline, current mortgage rates, the peak. We avoid a outright economic recession. It's a pretty sanguine economic outlook. And then I show several downside scenarios at different points in the distribution of possible outcomes. So that green line represents kind of like a CCAR-like stress test where you're way out on the tail, 4% probability that it will happen. But that's more like a crash. So you do get that would be a peak to trough decline in that scenario of about 20%, which anything over 10% peak to trough I would characterize as a crash on a nominal basis. So if we do suffer a recession, particularly a severe downturn, obviously crash becomes more likely. But in a more likely scenario where the growth weakens, unemployment may notch higher but doesn't rise significantly, I don't think national house prices will decline in a meaningful way. But there will be some price declines across the country, and that's the point of the last slide on the right. That's the 400 metropolitan areas again. And those areas that are in red or orange will experience price declines. Those in red, meaningful price declines over the next couple of years. The worst price declines are in those most used markets are close to double digit, kind of 10% peak to trough, like a Phoenix or Tampa. Although in the grand scheme of things, those are markets where prices were up 30% this past year and 30% the previous year. So you're only giving back a bit of what's been gained over the past few years. So with that, I will stop. I took my 15 minutes, I think, on the nose. I could have spoken for 2 hours, but I didn't think you'd like that too much. So I'll turn it back to you.